Extreme circumstances are taking place right now, and some of the most influential people in finance are talking about these details, including Ray Dalio, Stanley Druckenmiller, and others. I'm going to give you those today. Then we're going to talk about real estate, because what's happening there is not understood. People are seeing the prices that are extremely high and they're getting confused. They don't get it. Well, in this video, I'm going to explain that to you. In fact, my name is David Quintieri, and I have been doing this for well over 10 years. I'm generally 2 steps ahead, trying to bring you the information so that you have more than enough time to react to it. But it's so difficult for people to put all those pieces together. That's why I have this channel, so that I can bring you the truth, even when it hurts. You ready? Let's go. This is the first thing. Ray Dalio is basically talking about the fact that the US is at the beginning of a late big cycle debt crisis. And if you study this over time and understand his books, the principles books, it makes a lot of sense. If you don't, then of course it would be much more difficult. But basically where we are at is way too much debt, not enough income to come through, and the empire that is the US is at those last stages. That could be 10 years, that could be 100 years even, we don't know, okay? But all we do know is that when an empire, when a country takes on way too much debt, it will drown them. That is understood. But guess what? A lot of countries are doing the exact same thing. And so we could see that this is generally leading us into a very dangerous territory. Debt is not a good thing under these circumstances, okay? Because you have it on all levels, individuals, corporate, national, and everything in between. And how in the world are we ever going to get to a place where that isn't a burden? Oh, we'll just bring interest rates into the negative. That creates a lot of dislocations and distortions, which cause even more problems. You can't fix a problem by applying the same thing that you did in the first place to fix that problem. Like it just doesn't make sense. But that's what they're doing. Okay? And that's what they want you to think is okay. They want you to be blindsided and they want you to be distracted. We can't do that. Look at what Ray Dalio is saying, but check this one out. You could see it, Stanley Druckenmiller, one of the most successful investors ever in history. He fears that a recession is on the way after more than a year of aggressive interest rate hikes from the Fed that have failed to quash inflation. I want to make that clear. Not just the fact that they have increased the interest rates, but that what they've done so far hasn't been enough. The Fed hedge fund investor said that despite the economy's recent resilience, headlined by low unemployment rate, positive first quarter GDP growth, he believes a hard landing is inevitable. Jerome Powell has a soft landing 1,000 times in a row, but according to Stanley Druckenmiller, not going to happen. Our central case is that there's more shoes to drop, particularly in addition to the asset markets economically. And that's really where I like to focus on, especially here on this channel, looking at the economy itself, because you can't have everything that's been lined up here and not have the economy suffer. I mean, it's just a matter of fact. You look at what people are encountering right now, they're borrowing so much money. I'm going to show you this today. Parents are borrowing from their kids. Kids are borrowing from their parents. I mean, it's just wild. And all of this really shows us when you look at the amount of jobs that people have. Oh, look at the unemployment number. Yes, but how many people have 2 jobs? How many people have 3 jobs and 4 jobs just to keep up? That shows us that there is a crack or a hole in the statistics that they're giving us. But that's why you're here. You're here for the truth. Look at this. For years, Druckenmiller criticized the Fed, blowing up an asset bubble, and that's where we are at. This is part of a credit crunch that could be on the way as bank capital dries up and they take fewer risks amid the slowing growth. This is all happening today, and the very number one thing that he mentions, and that I've mentioned 100 times before, is commercial real estate, specifically highlighting SVB, Silicon Valley Bank, and we noticed that that was a big issue this year. Nobody noticed that last year. Nobody said anything about SVB. Nobody even knew it existed. Billionaire bond investor Jeffrey Gundlach dials up his warning of the US recession, pointing to signs of falling demand. Of course, you may know Jeffrey Gundlach, the bond king. Here he is, basically saying it's pretty clear that we have the look to soon be on the front of at the front end of a recession. Gundlach consistently rang the alarm on the oncoming downturn as the economy faces a raft of headwinds. These are things, of course, that you've heard me say 1,000 times. But look, you're not going to be getting me to just repeat these same things. I want to be very clear that when you go through a cycle, a big debt cycle, like Ray Dalio highlights in his books, you got to understand this, that you can't get away from that. What they try to do is they try to, let's say, boost it up. So we're going up higher, higher, higher. Oh, things are coming down. Let's make a soft landing by pumping it back up. Every time you pump it back up, you basically weaken it. Think about it. When you were a kid, you had Bubble, all those big chewing gums, right? Hubba Bubba, Bubbalicious, all these different things. What was that one, that's like 5 cents that came with like an Archie comic or something that was always hard as a rock? You would blow that bubble, and as it became bigger and bigger and bigger out in front of you, the thing would become thinner. And it was thinner, and eventually your whole face was covered in a bubble. That's exactly what happens with the financial system, with real estate, with some of this personal finance. The bigger it becomes, the thinner it is, and eventually it pops for one reason or another. Maybe somebody came in and stuck their finger and popped that bubble. But the whole point is that you can't get away from it. High interest rates and inflation together create a very, very dangerous proposition. Now, they do have an option. They can stop their policy. They can go ahead, cut interest rates, print money. As a result of this, they are going to ignite inflation to a degree we've never seen in our lifetime. Okay, we're already really bad, but it would make now look like nothing. So you tell me, what do you think they're going to do? Are they going to continue to push us further into an issue with commercial real estate and potentially, the other real estate and all kinds of different businesses? Or are they going to allow inflation to go wild? You tell me. I'd like to know what you think, please, in the comments below. I want this discussion to happen. And if you do not voice your opinion, you are standing idly by, and unfortunately, can't say that, can't say we all didn't try, right? We have to do this. We have to do anything we can. We got to voice our opinion. We got to just say, whenever I have a thought, I put it on Twitter. I just wanted to be known. I said, hey, I said that. I've got something interesting to share with you today. You know how we can buy fractional shares of things like famous paintings or real estate to diversify your portfolio? Well, take a look at Everbloom, a unique platform where you can actually invest in YouTubers and have a share in their future earnings. I think creators are like startups, and so does Goldman Sachs. Their latest research thinks the creator economy could be worth around $480 billion by 2027. YouTube creators alone earned over $16 billion in 2022. With those figures in mind, it's easy to see how investing in creators could be an interesting opportunity that is also fun for everyone using YouTube. Everbloom is like a venture capital platform for YouTubers. They let you invest in promising creators in exchange for a share of their YouTube earnings. Creators are then able to use the capital to hire a new editor, writer, or increase their production value. But Everbloom isn't just handing over the cash. They're also giving creators the support they need to really take off. For example, they're working together with MrBeast's retention director to provide creators coaching on how to grow their channel. What's more, Everbloom has the benefit that it's called guaranteed revenue share. It's basically a protection clause ensuring that you'll receive a minimum payout, guarding you against risks of creators quitting YouTube or having algorithm issues. Having been backed by Dapper Labs and founders of Candy Crush, Everbloom definitely has credibility. The platform is really user-friendly too. You can get set up and start investing in under a minute. So if you're interested in exploring a new, modern kind of investment, why not give Everbloom a look? It's a unique way to diversify your portfolio, and who knows, you might just end up investing in the next MrBeast. As a YouTuber myself, I find this very interesting. What about you guys? If you could invest in any YouTuber, who would you invest in? Let me know in the comments section. To check out the latest creators you can invest in now, go to my exclusive access link in the description. A pair of central bank decisions next week will shape the outlook for a wobbly global economy that the World Bank warns in a new downbeat. New assessment is battling stubbornly high inflation amid the aftermath of 2020. They talk about other things, China's reopening and so on, essentially saying from the World Bank, we are not going to get the growth that we thought we did, that we would get after 2020. Oh, everything's going to be open. It's going to be so fantastic. We're going to get growth back. But then inflation took hold. If we're going to ignore the trillions upon trillions that have been spent here, you can do that if you want. I'm not going to. I'm willing to take it head on. I'm willing to accept the truth that printing a whole bunch of money, that giving checks out to everybody, that giving businesses billions of dollars, and then saying, okay, you know what? We don't have to give that back. It's a forgiven loan. I would love a forgiven loan. I never got any money. What kind of garbage is this? How are they deciding who's winning and who's losing? I didn't get a penny through this entire period of time. And guess what? I got higher input costs for me as a multi-business owner. I got to deal with that. This is unbelievable. And so if we're not willing to look at the reality of it, we're going to get kicked in the behind. I'm tired of it, quite frankly. Billionaire, and this is going to bring me into the second part of this video where we talk about real estate. Billionaire investor Jeff Greene made $800 million betting against the last housing bubble. He just rang the alarm on U.S. real estate. Just because he got it last time doesn't mean he's right this time, but he makes a good point. Look, he said that offices would be hit hard if the recession struck, and AI eliminated some white-collar jobs. I think that's key. I had a comment on the previous video, one of the previous videos that I had done, and somebody said that where they work in IT, they're already eliminating jobs in this department because of AI. Think about that. Already. It's not coming tomorrow, my friends. This is already happening. Do you get it? I hope so. We are heading into a very frightening time in the real estate industry. What's happening in office space today? This is before the slowdown. Wait until we have the recession. So this is like, it's obvious, it's simple. We have the data, we have the information already. Let's talk about that real estate, okay? Remember, there's commercial, there's residential, two very different things. The Fed's, I love this, man-made housing market recession hit so hard that 4 real estate titans just lost their Fortune 500 status. Rocket companies and Zillow just fell out of the Fortune 500, okay? So they're just talking about that. I wanted to include it because it says it's a man-made, as if the Federal Reserve is doing this on purpose to crush them. Look, their U3 unemployment metric is like a record low right now, near record low. And like based on their data, there's absolutely no reason why they should be cutting interest rates at this time. It should be higher. Housing affordability will be low throughout the rest of 2023. Weighed down by higher mortgage rates and scarce inventory. This is very true for most places. In fact, housing affordability in all cases, your property taxes have gone up, your expenses that you've got to pay, something happens to the roof. Oh, that guy doesn't charge $200 anymore. He charges $400. Oh, you need some, a piece for your air conditioner. Oh, okay, no worries. Oh, yeah, unfortunately that part doesn't cost $100 anymore. It's $200. Everything is up way more than this bull, of 3%, 5%, 6%. No. I don't know why people are just, okay, I guess that's okay. And they're listening to the people who are spouting this garbage to you. I mean, it makes me sick. It really makes me sick. The things that people believe. Oh, I listen to this YouTube channel and that guy is a big BSer. Just follow in line. Just follow in line, people. Right off the cliff. Small businesses struggle to secure loans amidst rising interest rates, tightened policies. So it's the same thing going on for individuals, of course, small businesses as well. All right, big banks could face a 20% boost to capital requirements. Those relying on fees might need larger buffers to absorb losses under the planned rules. I want to see what's going to happen if they're going to be able to do this. They were already started what's called loan loss provisions, and that's basically like a rainy day fund. Put the cash aside. We know we're going to be dealing with some problems. Let's keep some cash here so that when inevitably people do default, businesses do default, they don't pay back, they're going bankrupt, whatever, we're going to have that cash on hand. That's already happening, but now that they could be required to boost how much cash they have. We'll see what happens with that. I think it's important that you, the individual, start asking the right questions. That's what this video does right here. It's simply to get us to understand where we are at today and where we want to be. We want to protect ourselves. We want to protect our investments, our assets. Get this video right now. Click it, and I'll see you there.